Gifting your house to your kids to avoid inheritance tax is often a mistake. If you're new to my channel, I'm Kiran and I'm a qualified chartered accountant with over 10 years of experience working in the UK tax profession. In this video, I'll explain the problems with gifting your house and I'll share a few alternative strategies. For most people, their home is their single largest tangible asset. And so it makes sense that they want to pass that on to their children and avoid inheritance tax being payable on their death. So lots of people will try to be proactive and they might consider putting their home into their children's names whilst they're still alive, thinking that that could save their children lots of hassle, headache, and also avoid the probate process on their house when they die. But I want to discuss three main risks of doing that in this video. And the first one relates to inheritance tax. If you die within 7 years of gifting your house to your child, it will be a failed, potentially exempt transfer, which means that inheritance tax will be payable on the house regardless of the fact that you gifted it, because you died within the 7 years. So there's no guarantee that by gifting your house to your child, you'll be able to completely avoid inheritance tax. But by far the biggest reason that most people will still have to pay inheritance tax after they gift their house is because they will continue to live in that house after they've gifted it, and then it becomes a gift with reservation of benefit. So if you gift your home to your child, but you intend to still live in that house after you've transferred it into their name, it's still going to form part of your estate and inheritance tax could still be due when you pass away. So let's say that you're in your 60s and you decide to give away your home to your son who's in his 30s because you want to be proactive and get that house out of your estate for inheritance tax and leave him with an asset after you've passed away. But you want to continue living in that house because you've lived in it for so many years and you've got nowhere else to go. In that circumstance, that house is still part of your estate because you are still deriving benefit from the asset, which means that when you die, your estate will still have to pay inheritance tax. The second risk of gifting your house while you're still alive is that you then give up control of your asset. So say that you gifted your house to your son, as in the previous example, and then your son got divorced. There's a good chance that he would then have to sell the house and give half of the proceeds to his ex-spouse, which then means that you are left with no home, your security has gone, you'll have nowhere to live, and you'll have to go and find a different property or move in with your son. So lots of people, I think, don't think about the long-term consequences of giving up control of their home, their single largest tangible asset. And it's not just divorce, it could be that your kids get into financial difficulty and then creditors come for the house. Or it might just be that your kids decide they want the money instead. Relationships with your kids might get worse and they could decide to sell the house, and then again, you've got nowhere to live and you've given up control of your house for no real reason. Sometimes people decide to give away their home because they think it will help them to gain financial assistance for care home costs. The average care home in the UK costs around £1,500 a week, and the local council will, as part of their financial assessment, look at your assets when deciding how much financial help you can receive for those costs. And so some people might think that giving away their home will allow them to benefit from some extra help. But the council often sees a house sale as a deliberate deprivation of assets, which would then mean that you've again given up control of your house for no reason, because the council will still continue to consider that house as notional capital when they come to assess your assets. So you might not even qualify for any additional financial assistance even after giving away your house to your children. I want to mention Xero, who are sponsoring this part of the video. If you're watching, chances are you are proactive with your finances and you might even run your own business. Xero is a platform designed for business owners to manage payments, control cash flow, and it can also integrate with other apps like Revolut Business, Shopify, and Stripe. There's the Xero accounting dashboard, which gives you a real-time view of business performance, and you can use the financial reporting software to create reports and then use those to speak to your advisors, and you don't have to spend ages manually pulling numbers together when preparing for meetings. Xero will even automatically calculate your tax liability and create an accurate return for you. I think Xero is a really good solution for small businesses so that you can focus on growing your business whilst Xero keeps you organized in the background. If you want to give Xero a try, I have a special discount for you in the link below. Let's talk about the alternatives to gifting your home. So the first one is to simply leave your home in your will, and that means making the most of your tax-free allowances, because the first £325,000 of your estate can pass on before any inheritance tax is payable. And then most people can benefit from the £175,000 residence nil rate band when they leave their home to their direct descendants. That means that you can pass on a home with a value of £500,000 before any inheritance tax needs to be paid. And then if you have a spouse and they also have unused allowances, it means that together you can pass on a home with a value of £1 million to your direct descendants without any inheritance tax being payable. For most people, that will be more than enough for them to be able to pass on their home without worrying about inheritance tax. And it's only when you've got other investments, like maybe other properties or significant stocks and shares, for example, that could increase the value of your overall estate, because your other assets will eat into that £325,000 nil rate band. And if the value of your estate exceeds £2 million, then your residence nil rate band reduces by £1 for every £2 that your estate exceeds the 2 million. So that means that whether or not you need to do any additional tax planning whilst you're still alive depends on the value of your overall estate. But like I said, for most people, making the most of their tax-free allowances will be more than enough. The second thing you can do is to gift a share of your home and continue to live in your home, but your child also needs to continue living in the home as well, because that will mean that the gift with reservation of benefit rules don't apply, and then that means that inheritance tax won't be chargeable either. But you and your child both need to live in the home. It doesn't need to be full-time, but there does need to be some genuine sharing of the home. And if it's a large enough home, it could mean that you live in one area of the property and then your child lives in the other area of the property. And in some cultures, this is quite normal anyway. So for lots of families, this might be an acceptable thing to do. For example, in South Asian culture, it's pretty normal for extended families to live together. So it could be worth doing this if it means that the value of your estate is large enough that the tax-free allowances won't be enough to protect your home from passing on without inheritance tax, and you're okay living with your child and the house is big enough for you to live together. The third thing you could do is to transfer your home into a trust. But there are anti-avoidance rules in transferring your home into a trust, because if you continue living in your home and you transfer it just for the purposes of taking the property out of your estate to lower your inheritance tax bill, then it will essentially still be a gift with reservation of benefit and the property will still be part of your estate for inheritance tax purposes. It can work in some circumstances though, so if you transfer your home into a trust and you move out of your home, maybe you decide to downsize, then the house may be excluded from your estate for inheritance tax purposes. So it could work for some people in certain circumstances, but trusts are actually very expensive. So when you transfer the house into the trust, the value of the house exceeds yours and your spouse's nil rate bands, then there will be inheritance tax to pay by the trustees when you transfer the house in. Plus, with lifetime trusts, you have to pay a tax charge every 10 years. You also have to pay a tax charge if you transfer the asset out of the trust. And you have to pay capital gains tax if you decide to sell the asset as well. So trusts are not always a good idea because they are complex and they can be expensive and they have their own tax charges. Some people decide to transfer a property into a trust in order to help with their financial assessments for care home fees, again thinking that the house will help to lower the value of their assets. But there's guidance that says that that rarely works, because again, care homes will consider that there's been a deliberate deprivation of assets and the value of the home is likely to still be included in your financial assessment. So that doesn't always work. So proceed with caution if you are thinking of transferring your house into a trust, and definitely seek legal and tax advice. Inheritance tax and estate planning is a complex area and you should take out specialist advice. This video is not a substitute for that. It's just intended to give you some more information so that you can go into conversations with a bit more knowledge. Thank you for watching. Please subscribe to the channel if you haven't already, because it really will help it to grow, and I will see you next time.